Yesterday was a bear channel. Actually, it was a spike in channel. A bear channel is a bull flag. 75% of the time, you get a breakout above the channel. When you have a spike pullback channel, the market typically breaks above the channel, tests the start of the channel, and enters the trading range. And here we are breaking above the top of the channel and also almost a measured move up based upon the height of the channel. Yesterday was a sell signal bar on the daily chart. And so far, instead of triggering the sell signal, we're up at yesterday's high. On the daily chart, we had 11 bars without a pullback right through here, which is unusual. It's similar to this. We had 13 bars here, went up a little higher, but then a trading range for a month. And I think something comparable to that will take place here. So yeah, we're just about at another new high, just like yesterday. But I think we're probably going to have a hard time going a lot higher over the next couple of weeks because this is so climactic. We have targets above. We have the top of the channel, which is above 4,500. I think we'll pull back before we get there. We have the 4,400 big round number. And then we have this measured move based upon the height of this 3-month trading range. So we may go up to 4,400 before we pull back. Today, if we go above yesterday's high, there'll be a micro wedge, up, yesterday, down, and then up. And the bears will try to get a reversal. The bulls will obviously want to reach the top of the channel. On the monthly chart, the past 5 months have had bull bodies. This would be the 6th month with a bull body. That has not happened in 10 years. And therefore, we're probably not going to get a bull body this month, even though right now we have a bull body. So I'm thinking there's at least a 50-50 chance we're going to get a reversal down in the second half of the month to below the open of the month. I said, we've had 5 consecutive bull bars several times in the past 10 years, but the last time that we've had 6 consecutive bull bars was back in 2011, right here. And after we had it, we had a 3-month pullback, 2 bear bars, and then a little bit lower here. So I think we're probably not going to get 6, but if we do get 6, it has not happened in 10 years, and the last time it happened, we got a 2-month or 2 down months afterwards. We just broke above the Globex high. On the 60-minute Globex chart, maybe an expanding triangle, 1, 2, 3, 4, 5, maybe a wedge, 1, 2, and 3. There's a 4-hour chart, possibly a wedge, 1, 2, and 3, but very strong bull trend, too strong. And usually when it's too strong, the market has to correct sideways for a lot of bars. It often goes a little bit higher, but usually not a lot higher. So I think this is the start of a trading range, and we're looking for the top of the range. Once we find it, then we'll come down to the bottom of the range. Another day, another new high, right? Pretty much every day recently, we've had a new all-time high. And that's common when the market's in a bull trend. Every day is a new high. Bears want a perfect double top 31, and the bulls want another new high. Yesterday's a sell signal bar on the daily chart. We reversed. We went up, we went down. And instead of going below the low of the sell signal bar and triggering the sell signal, we're on the verge of going above the top of the sell signal bar. Yesterday's range was average, not huge. It's possible that today could become an outside down day, that we go above yesterday's high and reverse down to below yesterday's low. Remember, I'm thinking that we're probably going to sell off in the second half of July. And that does not mean it begins on July 15th or July 16th. It could begin on July 28th. I think the bulls will probably take profits after 5 consecutive bull bars on the monthly chart. Okay, so another new high. Is it by the close? Well, it's certainly a surprise. We have a sell signal bar on the daily chart. Instead of going below the low of the bar, we're going above the high of the bar. The math is usually the probability is usually higher if you wait for consecutive bull bars. Especially in a situation like this where it could be a failed breakout above yesterday's high and we could get a reversal down. So whenever there's a buy signal, always look to the left. And if you're at resistance, that rally might be simply a test of the resistance instead of a successful breakout above the resistance. A general guideline that a lot of traders use is they want to see two closes beyond support or resistance to conclude that the support or resistance is not holding. And here we're breaking above the bear channel, so that's resistance. We broke above it. We're breaking above the moving average, and so we have one close above the moving average. We have a close above the bear channel. We broke above yesterday's high, but bar one closed below yesterday's high. The computers did that on purpose. It's a sign that the bulls were not quite as strong as they could be. The bear computers were able to do that. The bull computers were unable to get a close above yesterday's high. And the bull computers see that, and some of them are taking profits. They're saying, oh, we broke above yesterday's high, but we did not close above it. Maybe the bulls are not as strong as possible. And if they're not as strong as possible, do I really want to be long this far above the average price? So some of the bulls are taking profits here on 2. If enough of them do, and 2 closes near its low, then you'll get other bulls selling, and you'll start to get bears selling as well, taking a chance that this is just a higher high double top with the high of yesterday. We had something like that happen a few weeks ago where the market either made a perfect double top with the all-time high or went a little bit above it. Here, a big bull bar and then reversal down, a double top. And then here, new high, and then reversal down. I said a lot of bulls want a second consecutive bull bar. At a minimum, they want no bear bar. Yesterday, it was really interesting in the open yesterday. We had a bull bar after a gap down, close above the midpoint, and then the next bar did not have a bear body. So it was the absolute minimum that the bulls needed for a buy the close type of rally. 2 bars, one with a decent sized body closing above its midpoint, and the other not having a bear body. And because it was the absolute minimum, the rally was probably not going to be all that strong, and therefore it was probably not going to last all day. So the fight right now is over the close of 2. The more it closes on its high, the more bulls will buy it. The more it closes on its low, the more the bears will sell it. Just waiting to see what the close looks like. Will it close on or near the low of the bar? If so, traders will sell. Will it close with no bear body, like bar 2 yesterday? Then you'll get traders buying the market or buying on a stop above 2. 1 tick bear body. So not enough to make bears short. Bulls, if they bought above 1, a lot of them are disappointed by 2, and they may try to get out break even. So this is their chance. And if a lot of the bulls who bought the 1 close or bought the 1 high exit, you'll get a micro double top. Up on 1, down on 2, up on 3, down on 3. And then traders will look at 3 to see if it closes on or near its low. If it does, it would then become a sell signal bar. So right now we're probably always in long. We have a big breakout above the moving average and the bear channel from yesterday, and a breakout to a new high. And we have a big bull bar closing near its high. So probably always in long, so it's more likely that will go higher. But 2, having a 1 tick bear body, that is important. Every tick matters. You sometimes hear people talk about noise. Oh, that's too small to matter. It's noise. Well, noise simply means something that's not important to you. It usually means a movement on either a smaller time frame chart, usually a smaller time frame chart, but it can also mean movement on a higher time frame chart. For example, how many of you right now are looking at the monthly chart or the yearly chart? The yearly chart, whatever's taking place on it, you don't care right now. And therefore, for you, it's just noise. It's a distraction. And how many of you are looking at a 5-second chart? None of you. And you don't care what's going on the 5-second chart. So for you, it's noise. I think one of the mistakes in the trading world is academics talk about noise as if it's a real phenomenon, that there is truly random movement in the markets. And it's not possible. Everything that takes place is being done because of a computer algorithm, so it's being done based on logic. It's not random. Every tick matters. Bar 2, having a 1-tick bear body, matters. It's a statement. If 2 was like 2 yesterday and had no bear body, traders would be buying, just like bar 3 yesterday. That 1-tick bear body is enough to make traders hesitate. What about the Globex market? We have a bull channel and a bull breakout. 75% chance the breakout will fail within about 5 bars. Here, it did not fail. And so then you expect a second leg up, and we have the second leg up. We may get a third leg up. This is so strong, it could be the first of 3. 1, pull back 2, pull back 3. When you have a bull breakout of a bull channel, you're looking for 2 things. One is a couple legs up, which we have, and the other is possibly a measured move up, which would be up there. Now, the Globex chart will be a distraction. I can look for signals on the Globex chart, on the 15-minute chart, on the 10-minute chart, on the 7-minute chart, the 3-minute, the 2-minute. It's not worth it. I'll see enough on the 5-minute day session chart. I don't want to be looking at all that other stuff. This is the 15-minute Globex chart. Expanding triangle, 1, 2, 3, 4, 5. Higher high double top. Possible final flag, couple sideways bars. Second leg up, 1 pullback 2 after a breakout. Now, I said the bears wanted to sell below 2 if it was a bear bar closing on or near its low. And now 3 is a micro double top. The buy the close bulls 1, disappointed 2, gave up on 3. So once they saw 2, a lot of them placed limit orders to exit at their purchase price around the 1 close or the 1 high. And that's what took place on 3. So this is a sell signal for a possible high today. But it's not a scalp. So if you sell below 3, you're not looking for a 1 or 2 point scalp. You're hoping that it's like 31 yesterday in the start of a bear trend. But a lot of times, especially when you have a big move, it's not going to go straight down. It'll go sideways like yesterday. Credible sell setup for the high of the day. Right now, I would say 30% chance we've seen the high of the day. So that means at this moment, 70% chance I think we have not seen the high of the day. However, if 4 is a big bear bar closing on its low, it will be 40%. If we get 3 or 4 bear bars, then it'll be 50 or 60% that this will remain the high of the day. But right now, 70% chance this is not going to be the high at the end of the day. Very often when you get a sell signal that triggers, the entry bar becomes a buy signal bar. The bulls are hoping this is a small pullback bull trend and that will go higher. I did not sell below 3. 1 is very strong. Plus the bull trend on the 60-minute chart, daily chart, weekly chart, monthly chart are all strong. And we have 2 important targets above. Both are within reach. The 4,400 big round number, 20 points above where we are, and then the 4404 measured move based upon the height of the 3-month trading range. And that's also about 20 points higher. And, that's, that's less than an average day's range. So we could easily get to both of those targets today. To buy above 4, let's say you're a bull, and let's say you get out below 3, and you're trading always in. Well, you want to buy again if it starts to go up. And at a minimum, you want a bull bar 4. You would like a bull bar that closes on its high and has at least a decent bull body, 3 or 4 tick bull body. And for the bears, if 4 is a pretty good buy signal bar, a lot of bears might get out above 4. Otherwise, they'll keep their stop above 3. You can see the market's deciding, is this the reversal down or is it a pullback, and will we continue up? Remember I said 70% chance this is not the high of the day. So that means I think we're going to go higher. But the more bearish 4 is, the lower the probability that we go higher it becomes. Bears want to break below the low today, 1. And they want to get as many bear bars as they can get. They're hoping this is the start of a bear trend. The bulls are hoping it's just a bear leg in what will become a trading range open. The more 4 closes on its low, the more traders will think this might be the high of the day. The bigger the tail on the bottom of 4, the more traders will think that we're in a trading range open and that this is not the start of a bear trend. It's the start of a trading range. Consecutive bear bars, at least one with a good sized body and closing on or near its low. That's enough on the open to make it always in short. The bulls will try to get a double bottom 1. They're still hoping that this is a pullback from 1. And the bears are hoping it's a reversal down from 1. And right now it's both. Which is more likely? I think it's probably 50-50. The instant 4 went below 3, it was still more bullish. But after seeing 4 close like this, I would say it's 50-50. Big up, big down, big confusion. Need more information. Bulls trying to keep 5 from going below 1. They're hoping this is just a pullback from 1. And the bears obviously want to break below 1. And they'd obviously like to get one more bear bar. 4 is comparable to 1, right? So 5 is comparable to bar 2. The bears at a minimum want no bull body. They would like a second consecutive big bear bar closing on its low. That would increase the chances that we are starting a swing down. Trading ranges are always more likely than trends. So whenever you look at something and you say, is this a pullback or is this sort of a trend? I always assume trading ranges are more likely because they are. Look at yesterday. We had a very strong trend here, but the rest of the day was not strongly bullish or bearish. We went up for a couple hours, down for 5 hours, but it was only strongly bearish here, and it was never all that strongly bullish. Trading range open, reversals. Something wrong with everything. The bulls needed a bull body on 2, did not get it. And the bears needed a breakout below 1, and they needed a bear bar on 5, and so far it does not look like they'll get it. So when you're looking for something to happen to confirm your belief that the market might be trending, and you're not getting that confirmation, then the market is probably not trending, and that means trading range. Remember, the minimum the bears want is no bull body. And that would be enough to increase the chances that will go lower. And the minimum the bulls want is a 1-tick bull body, but they would like 5 to close on its high for a double bottom by 1. Bears, reasonable to get out above a bull bar, even a small one. Reasonable to get out a point or two above any bar, including a bear bar. Okay, so that's the minimum that the bears needed. No bull body, so that's more bearish than neutral. Bears, reasonable to get out a point or two above 5. Alternatively, you get out above 3. You can see a lot of bears are getting out. You can see it bouncing a little bit. So the bears are sold below 3. They were hoping to make 10 points, and some of them exited with 4 points. And actually, it was, I think, a 17-tick trap, so they did not quite get 4 points. And now some of them are trying to get out with 2 points. Can you buy above 5, a higher low double bottom 1? I would wait for a bull bar closing on or near its high. If it's still always in short, can you sell at the market, sell above 1? Yeah, you can put a stop above 3. Best choice right here. Well, best choice is flat, but I'd get out a point or so above 5. And for the bulls, I would not buy above 5. If 6 is a bull bar closing near its high, then I think bears will get out above 6, and you'll start to get bulls buying again. Bears, since we have 4 bars without a bull body, won't they sell above 5? Yeah, they will. And that's part of the reason why 6 has not gone above 5. There are probably too many bear computers with limit orders to sell at the 5 high and 1 point higher, 2 points higher. Bar 6 is the end of the first half hour. It's also the second 15-minute bar. You can see it's a 2-bar reversal on the 15-minute chart. And finally, it's at 7 o'clock. And that makes it a little bit tricky because there's sometimes a news announcement or report at 7 o'clock. So the market sometimes quickly moves in the final second of bar 6. And then also sometimes quickly moves on the start of bar 7 if somebody released some news or if there was a report. For the bears, down on 2, up on 2, down on 4, up on 5, down on 6, up on 7. That's not good if you're a bear because that's 3 legs down on a small time frame chart. There's a potential micro wedge. So for the bulls, they're still looking to buy, but they'd like to buy above a bull bar. So you can see 7, how we went down on 6 and up on 7. Probably somebody said something, or there may have been some report that came out. Just like 1 was possibly simply a test of yesterday's high, 6 could be possibly a test of the start of yesterday's bear channel, 47 or 54. Bears, they should get out, I think, a point or so above a bear bar, 6. In fact, I think it would be reasonable to get out a tick above it because of the possible parabolic wedge. And for the bulls to buy, I think they should be waiting to buy above a bull bar closing near its high, possibly bar 7. Now, some traders sold below 1, a breakout of the day's range. Some traders bought the 1 low and bought more lower. The traders, the computers that bought the 1 low and bought more lower made money. All right, so they buy the 1 low, they buy more, 1 point lower, 2 points lower, and then when it gets back above the 1 low, they sell. And that's what this tail is, the bulls selling. If the bulls are selling, you get a tail, and it means they don't have a lot of conviction, a lot of confidence that this is the start of a bull trend. They look at it as a trade, scalp. the bigger the tail on the top of 7, the more the bulls are scalping, the more the bulls are not confident that this is the start of a bull trend. I always pay attention to follow through. And if you consistently get bad follow through, even if the market's trending, the trend is probably part of a trading range. So you'll probably get an opposite move. Bar 1, bad follow through 2. Bar 4, breakout, bad follow through 5. Bar 6, breakout to a new low, bad follow through 7. So always in short, bear trend, 6-bar bear microchannel, but there's something wrong with it. We're not getting sustained selling. It goes down, the bears buy back shorts. It goes down again, bears buy back shorts. It goes down, bulls buy. So bulls bought the close of 4. They bought below 4. They bought below 1. They bought the close of 6. And they're consistently making money. And if the market is in a reasonably strong bear trend, it should be very, very difficult for bulls to make money. Yet, here we are, selling off, and it's fairly easy for bulls to make money. And therefore, this is not yet a strong bear trend. It's either a weak bear trend that will convert into a trading range or reverse into a bull trend, or it's already in the process of ending and evolving either into a trading range or reversing into a bull trend. For the bulls, a lower low double bottom 1, but a 6-bar bear microchannel that will reduce the number of bulls willing to buy. 6 bars without a pullback, that is enough sustained selling to reduce the number of bulls willing to buy. And then the bulls who do buy above 7 have a stop far below. That means big risk. That will also reduce the number of bulls willing to buy. So if we're going up, but bulls don't want to buy, what happens? Bulls take profits, and maybe we go up a little, but not a lot. Bears, reasonable to get out above 7 or above 6, and for the bulls, it's a possible low of the day, but a 6-bar bear microchannel and 5 bars without a bull body. Higher probability to wait for a better setup or for a surprise bar up. Bears want micro double top, up on 5, down on 6, up on 7, and then they hope down on 8. Parabolic wedge, a lower low double bottom, test of the 47 high, possible low of the day, but 6, maybe 7-bar bear microchannel, and not quite down to support. Moving average, 47 high, 54 high. So it's still more likely that we're going to go down at least a little bit more. If we do go down, it could form a bigger wedge, 1, 6, and 9 or 10 or something. And if we were to reverse up, it would be at support, moving average, and these highs. Low 1, but a 4-bar tight trading range and a tail. So it's lower probability. I think we're probably going to get a third leg or third bottom. We have 1, 2. I think we'll probably come down here, but this is not the kind of thing you'd sell for a scalp. I did not sell it. I know it doesn't look like it, but it is an II 7-8. So a possible final flag. We had a couple IIs yesterday. Bar 49 was actually an III, and then we had an II 71, and both were final flags. They did not lead to bull trend reversals, but they led to a halt of the selling. So we broke below it and sideways. Broke below it, sideways. The market tends to form patterns in clusters. So it tends to form a lot of OOs for several days, or a lot of expanding triangles for several days, or wedges, or double tops and double bottoms, or IIs. Well, the bulls, micro double bottom, 6, 9, but a bear